Marianne, can you hear me? Marianne, please confirm. Jack can hear me. Marianne, can you hear me? Please confirm. Marianne can hear me. Thank you so much. So we are going to start right now. And I want to just briefly take you through the course outline. I think you all know my name. I'm Priska, and I'll take you through this training for the next 2 weeks. And also we continue the mentorship program until you're confident and you're comfortable with trading. So our course outline covers the following areas. So we have the key terminologies in Forex, and I believe we've all gone through that. And why we need to know these terminologies for us to be able to do proper analysis. You have to understand the language of the Forex market so that you can do proper analysis. And also, when we read other reports about Forex, the terminologies you're able to connect and understand what is the analyst trying to say. Okay? Then we also cover the introduction to Forex. That's what we call the overview of the Forex market. Then you do the technical analysis and patterns. That is now where the work is. That is technical analysis, because here we are going to learn how to analyze the price charts and make a decision when to sell, where to place your stop loss. We'll see what a stop loss is, where to place your take profit, when to enter, when to exit. So our main work will actually be at our topic number 3, where we cover the whole technical analysis, and it has all those listings under that. Then also go into number 4, which is fundamental analysis. We do currency commodity correlations. There we try to look at which commodities affect currencies and which currencies are affected by which commodities. Like some of those commodities are like gold. Which currency is related to gold? When you talk of oil, which commodity is related with oil and how do they relate with each other? We also look at that. Also, we look at trading psychology and risk management. In Forex, you must do proper risk management. Otherwise, you're going to lose so much. So, number 6 is a very key topic. Trading psychology, how you manage your emotions, and also how you manage your risk to protect your capital, also to minimize losses and ensure you make the best out of the market by making more profits. So today we'll focus on the key terminologies in Forex market. Please note you're free to drop a question anytime to seek clarification. Yeah, you can do that anytime you want to seek clarification. Hope you can all see that. That is the glossary about the key terminologies used in Forex. I like connecting with my phone so that I can see what you're seeing, so that together. I'll try to connect in as we proceed. So the first terminology is Forex, yeah? And you see the word Forex is short form for foreign exchange. Trading, and it consists of buying and selling world currencies. In Forex, we sell money. We buy money, we sell money, okay? It's about buying and selling world currencies. Just 1 second. And its marketplace is most in the world. The unique aspect of trading Forex is that individual investors like me and you and speculators can compete. Like even some of you in the banks, I'm sure you agree with me that banks make a good percentage of their profits from Forex, not necessarily from the loans they give to their customers. But Forex brings the bigger chunk of their profits. Yeah. So those are the guys we compete with in the market. Yeah, but that should not actually scare you. In your analysis, you see they are selling, you sell with them. You see they are buying, you buy with them. Again, we say in Forex, it's the only market you make money in 2 ways. By selling and buy. You don't have to buy and wait always. If the market is up and you expect it to go down, you sell, you make your money. If dollar is weakening, you sell, you make money. If dollar is strengthening, you buy, you make your money. So it's only in Forex we make money in two ways. You sell, you make your money. You buy, you make your money. You don't have to wait for it to reach a certain level, unless just based on your analysis. But you can always do whichever direction you buy or you sell, and you make money. It's the only market which allows that kind of a transaction, okay? Like when you look at shares, for you to make money, you have to buy shares. You wait maybe even for some months. It appreciates, then you dispose them off. But in Forex, again, you see it is the most liquid. By liquid, we say it means you can dispose that commodity the soonest time possible. If you remember in the class of commerce or business, we used to have the liquid assets, yeah? And the class of liquid assets were those assets can easily be converted to cash. So Forex is the most liquid market in the world, where you can actually convert within 2 minutes. You can buy right now, in 2 minutes, you sell, you close your trade. There's always a seller at any moment. There's always a buyer at any one moment, because also it has many participants. So you can always close your trade. You don't have to wait and wait for a trader to or buyer to come from wherever, or a seller to come and sell for you. No. At any second, every moment, there's someone willing to buy, someone willing to sell. The question is, are you willing to sell or to buy at the price, the prevailing price at that moment? And that's where analysis comes in, for you to analyze and see at what price will be my best price to buy or to sell. Okay? So again, we talk of the currency pairs. Forex is traded in pairs. Okay? So you think of money as a commodity. You're buying a currency hoping that its value will increase. And if you're selling, you're betting that it will decrease. Okay? So if you expect the dollar to go down in value, you sell it. If you expect it to go up in value, you buy it. But again, you ask yourself, it is increasing in value based on what? Or compared to which one? So you have to do it in pairs, okay? Like if it's USD CAD, CAD is the Canadian dollar, and you're saying dollar is strengthening, the CAD is weakening, so it means at that moment you're buying USD CAD. In that transaction, you're buying the dollar and selling the CAD. If you buy USD CAD, the transaction is you're buying the USD, the first currency actually what you're trading. You're buying the USD and at the same time selling the CAD. So they are always in pairs. Yeah, it's not just by itself, you just buy the dollar. No, it's always in comparison with another currency. If it is the USD versus Japanese yen, if the dollar is strengthening, the JPY is going down, you buy the USD as you sell the JPY, okay? Then we talk of quoted currency and the base currency. So in Forex, currencies are quoted in pairs, just as we've said. So for example, we have USD EUR. EUR is the currency for Europe. Yeah, the 27 states of Europe, they use a common currency, which is the euro. So if we are dealing with the USD EUR, that is the US dollar versus the euro. Using this quotation, the value of a currency is determined by its comparison to another currency, just what we said. So the first currency of a currency pair is called the base currency. The first currency, so the currency on the left side of the slash, that is called the base currency, okay? And the second currency is called the quoted currency. So we quote based on the base currency. So it's always like USD EUR. If you're given USD EUR is equal to 1.222, it means you need 1.222 of EUR to get 1 unit of the base currency. Okay? So anytime you're quoting, it means you require that amount of the quoted currency to buy or to sell 1 unit of the base currency. So the first currency on the left side of the slash is called the base currency. And the second currency is called the quoted currency. Don't worry, this will come automatically with time. Don't have to struggle to know which is which, but just come automatically. Just good to understand what is where and which is which. Then we have the bid and ask price. These are the main prices we consider when we are trading currencies. Just like buying a stock in the stock market, when trading currency pairs, the forex quote will have a bid price and an ask price. So the bid and ask prices are always quoted in relation to the base currency. Again, we'll see in details what that actually it means. So if you're selling the base currency, the bid price is the price the dealer is willing to pay to buy the base currency. Okay? When you're selling the base currency, the bid price is the price the dealer is willing to pay to buy the base currency. So when you're selling, you look at the bid price. Actually, that is what you are. If you sell, that is the price which will be applied. We look at just look at a case where we have an auctioneer. When you're doing auctioneering, we hear of the highest bidder. Okay, the highest bidder takes the day. So it is the same case here. We are the one selling. I am selling this currency. So the other person is giving me an offer. That is the bid price. He is bidding my transaction. So if you're selling, you look at your trade will be filled or your order will be filled at the bid price if you're selling. And see, the bid price is the price the dealer is willing to pay to buy the base currency from you. So simply put, it's the price you will receive if you sell. Just like any other market. Okay, if you're selling, the price which you receive is the bid price. So when you're buying the base currency, the ask price is the price at which the dealer is willing to sell you the base currency in exchange for the quoted currency. Okay, so simply when you want to buy a base currency, the ask price is the price you're going to pay. So we are saying when you're selling, you look at the bid price. When you're buying, you look at the ask price because you're buying. Like if you go to the market right now, like let's talk of where these guys sell the goats. Is it Jamaica? Yeah. So this person, the owner of the goats, has the asking price. I'm asking for this amount of money for me to give you my goat. Okay. So if I'm the one going to buy, I'm looking at the price this guy is asking for. So when you're buying, you look at the asking price. When you're selling, you look at the bid price. Again, this will come automatically as you go down. You don't have to struggle with it. It's just a knowledge you need. Some of the terms you need to understand in the forex market. And we have an example here, like the pair USD-CAD, and we said CAD is the Canadian dollar. If we have a quotation, USD-CAD is equal to 1.2000/05. In that quotation, we have the bid price and the ask price. Okay, so the first price before the slash, the 1.2000 is the bid price. So if I was to sell USD-CAD, my order will be filled at, I might actually see that just price appearing like that, 1.2000/05. So if I sell, my order will be filled at the bid price, which is the first price, which is the 1.2000. What it means, for me to sell 1 unit of, if I sell 1 unit of dollar, I will get 1.2000 of CAD. Okay? That's actually the interpretation of that kind of a transaction. Then in the same quotation, we have 1.2005, and that is the asking price. If I am buying, the market maker or the dealer will sell it to me at 1.2005. Because you know the buying price and the selling price must be different. Okay? The bidding price is the price at which my selling order will be filled at. My buying price is, so the ask price is the price at which my buying, if I'm buying, my order will be filled at. Okay? Again, we'll get it in details very clear as you go down. But if you have a question, please ask. You don't have to wait till the end. Anyway, it's not clear, just ask. I'll explain the best I can to ensure you get it. Then we have the PIP. Pips or a point is the common name used to refer to incremental changes in a forex quote. So a change from like the case we had there, like 1.2000. If it moves up, that pair moves up to 1.2001. It means it has moved up by 1 pip. That's how we count the change in a currency price. So that change is counted in terms of pips. So that movement on the 4th decimal point, just one move, that is 1 pip. And at times, currency can move by like 200 pips, 100 points just in one day. So that's how we calculate how the pair is performing, or how even to calculate our profits or our losses if we make a loss. Okay, so we are saying like movement from 1.2000 to 2001, it means the pair has moved up by 1 pip, and that's how we calculate the currency movement and how we calculate our profits at the end of the day. So although these currency movements may seem small due to leverage used in the forex market, small changes can result in large profits or losses. Yeah. So although it may look small, like we are talking of decimal point movement, but if it moves just by 1 pip, 1 pip is equivalent to plus or minus $10 if you're dealing with one standard lot. Okay. So if you bought a whole lot, one standard lot, we'll get to know what a lot is. So, and it moves by just 1 pip. That means you've already made $10. Again, you're saying a pair can move even 200 pips in one day. So if it moves 200 pips in your favor, you're making 200 times 10 if you had bought one standard lot. Okay? So if it moves 200 points or pips in your favor and you had bought one standard lot, it means you have made 10 times 200. That is the $10 per pip times 200 pips, that 2000 USD you're making in profit. Again, if it moves against you, you're also talking the same language when it comes to losses, okay? But going into details how all that works. Then we talk about the spread. There's this term called spread, and we say spread is the difference between the bid price and the ask price. Actually, spread is how the brokers make their money. Okay? That is why you realize when you are selecting brokers, we are very key to know what is the spread for that broker, because a spread can actually make you or break you. If the brokers have a very wide spread, it means you're losing so much money. They're eating so much of your profit. Okay? So it is very key to consider what is the spread of that particular broker. How much are they making from me per transaction? And you're saying the spread is the difference between the bid price and the ask price. The bigger the spread, the more losses as a trader you are likely to lose, and the more money the broker is making from you. The smaller the spread, the more benefit to the trader like you and me, and the less that broker is, it means he's not so greedy. Yeah. And many brokers, spread can range from 0 point something to 1 or 2. But there are some really greedy brokers. You will find a spread of like 10 pips, yeah, or even more than that. But also there are some occasions, some instances where the brokers are not in control of the spread. Like when there is release of hot news, the spread widens because there is high volatility. Again, you look at all this in details, but for now we know the spread is a difference between the ask price and the bid price. And that is how the brokers make their money. The smaller the spread, the better for you as a trader. So when you're selecting a broker, it's very key to consider what is the broker's spread. Okay? So we want to analyze that quotation further to get more understanding of that quotation. When we have USD CAD is equal to 1.2000/05. So from that, what can we make of that quotation? Okay? And you're saying from that quotation that USD CAD is equal to 1.2000/05. From that quotation, the base currency is the currency to the left. That is the USD. And from that quotation, our quoted currency, which is the currency to the right, is the CAD or Canadian dollar. From that quotation, the bid price is 1.2000. That is the price for which the market maker will buy the base currency. So bid is always smaller than ask. Bid price is always smaller than ask. With all the brokers, with everyone else, that is how the market is set up. Okay? So, because basically everybody wants to buy at a lower price and sell at a higher price. So just like the way it works in any other market. Okay? then ask price in the same quotation, our ask price is 1.2005. That is the price for which the market maker or the dealer will sell the base currency. Yeah, if you're buying. Again, we say the pip, it's 1 point move. That fourth decimal point movement, if it just moves by 1 point, it means it has moved by 1 pip. It's 1 point move. So in our case of USDCD, it is 0.001, and 1 point change would be from 1.2000 to 1.2001. It means that it has moved up by 1 pip. So the pip is the smallest movement in a price, and that's how we calculate how that pair is performing, and that's how you calculate how you're making your profit. That's how you calculate how your trade is performing. Okay. Then we say the spread is the difference between the bid price and the ask price. So in our quotation, the spread will be 5. That is 1.2005. That is the ask price. Take away 1,2000, which is the bid price. So the difference is 5 pips, and that is the spread. Hope you're together to that level, but please ask. Yeah? Don't float, don't get lost. I want us to be together. So we go to the word called lots. Yeah? So we are saying, similar to how most stocks trade in lots, to facilitate trading, currencies are also traded in lots. Like when you look at Nairobi Stock Exchange, if I want to buy Safaricom shares today, I cannot just buy one share, okay? Shares from Nairobi Stock Exchange. They are traded in how many, in what quantities? How does Nairobi Stock Exchange? If I was to buy Safaricom shares today, can I just go and buy one share? Or how are they grouped? Anyone with an answer? How does it operate at Nairobi Stock Exchange? If I was to buy Safaricom shares, could I just go and buy one share from Safaricom? You guys have not been, somebody is typing, let me wait and see. Beautiful, minimum 100. Thank you, Marianne. So that is the lot. When it comes to shares, shares are sold in lots of 100 or multiples of 100. So the same case in Forex, we also have lots. This makes it to be more manageable, okay? It makes it easier to operate, and also to apportion profits and losses and effort. It makes it easier to operate. Just imagine if Safaricom, you can buy one share. You can imagine they would be having like 40 million shareholders. Okay? One with one share, another in 2 shares. So even apportioning dividends, it's headache. So, but when they are in multiples of hundreds, it becomes very easy to know your shareholders, list them by number of shares very easily, apportion your dividends without headache. So also in Forex, it's also apportioned in lots, okay? And one standard lot is equivalent to $100,000, okay? So it is typical to the standard lot. So one lot is equivalent to $100,000. But again, if the market maintained these kind of standards, me and you, we cannot participate. We'll just be locked out. Where would you get money to really trade like that? So to make it easier for some of us, me and you, the small traders, to participate, they have broken it further to mini lots, which is 10,000 USD, and a micro lot, which is $1,000. Again, that is still so high for some of us. So to make it even more accessible to all of us, now we have what we call the leverage. The brokers enable us. When we even have like $10, they give us like a loan where we're able to trade as though we have all the money we have in the account. So we have said we have the standard lot, which is 100,000, but it is further broken down to enable us to participate, yeah, to mini lot, which is equivalent to $10,000, and micro lot, which is equivalent to $1,000. Okay, but again, you don't even need $1,000 to trade in Forex. Because of leverage, it enables us to even trade Forex with less capital than $1,000. Although this may seem like large amounts, but because currencies only move in small increments, only a few pips at a time, a large amount of currency is needed to generate any sizable profits or losses. But again, that's how now the leverage comes in. And we go to our next point, which is leverage. Okay? And you're saying leverage is the use of other people's money to buy or sell contracts or securities. Just to use in our own terms. Again, we said because the way the market is set up, it may require you to have so much capital to participate. But the small traders like me and you, we don't access the market directly like the big banks. We go through the brokers, okay? They give us the platform, then they also give us a loan. They enable us. You know, they finance you to access, to be able to trade as though you have big monies, okay? And you say like, one of the messages told you to select a leverage of 1:500. What that means, if the brokers offered you leverage of 1:500, it means for every dollar you invest, they will give you 500 times to trade with, okay? So if you have $100 in your account and your leverage is 1:500, it means you can trade a contract worth 500 times 100, which is 50,000. Okay? So you can almost actually trade like half of a standard lot or 5 mini lots. Okay? So the brokers, the leverage enables us to use our little money but trade in big volumes. Okay? So what happens? That leverage, that loan they give us, they don't put that money into our account. The system is set up in such a case that once you've selected a leverage of 1:500, anytime you trade, the leverage, the loan is made automatically available in the system. Okay? They will not put like 500 times 100, 5,000 in your account, but they will enable the system. Although in your balance you're seeing the $100 you deposited, the leverage will enable you to place a trade. It automatically picks the multiplication to allow you to trade in large volumes, which require more money than your $100. That's how leverage works. Again, there is no loan. We don't pay interest on this loan. What happens, depending on the pair you're holding, if you owe that pair overnight, okay, it attracts what you call swaps, depending on the particular pair. And a swap is calculated based on the interest differences of the pair you're holding. That sounds complicated, It's not. What you're saying, like if you're holding USD JPY, USD the base currency versus JPY the quoted currency, yes, USD the interest rate is 2. Currently the rate for USD it is 2.5. Yeah, like now when you talk about the CBK rates, currently it must be around 9 or 10 there. I'm not very sure. That's not our CBK rate. So for the USD, the rate the Federal Reserve Bank of the United States has said is 2.5. That is the CBK rate. Then for JPY, the interest rate is currently it is 0. So when you buy such a pair, the interest difference like 2.5 because dollar is 2.5, Japanese yen is 0. So that pair will definitely attract a swap. And depending on your position, if you are long, or rather, if you have bought, let me not use the word long, we've not yet reached that term. If you have bought USD JPY and it sleeps overnight, it will attract a swap, but that swap will be a positive swap. It will be an earning on your side. Okay? If you have bought USD JPY, you held it overnight, because of the interest differential, it will earn you something. But if you sell USD JPY, again, because of interest differential, because you have sold the one with the higher rate and the one with the lower rate, in such a it will attract a swap, which will be a negative on your side. Again, it's very negligible. It should never bother you. As you say, I cannot hold overnight because of a swap. No. It can be 0 point something depending on the size of your contract or the size of your trade. If it's how many lots and something like that. Okay, so that's the only time you pay something based on the leverage. It can either be a swap which is positive to in your favor or negative, depending on the currency you're holding and whether it is a buy or sell, and that will only happen if you hold overnight. If you buy in the morning, you sell at night, no swap attracted. That only happens if you hold overnight, okay? So leverage, like a loan, leverage is a loan we get from the brokers to enable us to participate in this huge market. Then we have the word margin. Margin is basically more or less like leverage. But when you enter a trade, so now you see these words being used there. You'll see your margin percentage, your margin level, okay? It shows the amount of borrowing, or rather how much the percentage of your money which has been committed to that trade. So more or less margin leverage, they just mean the same, just like about the loan from the broker. Then we have the margin call and margin stop out. What happens? Every broker has put up some measures to protect themselves, okay, to ensure, although they have loaned you, they will not allow you to lose to a point of them losing their money. So they set up some percentages, okay, like I used the case for FXTM, okay. If your account has $100 and you buy like 0.5 lots, or one, let's just say one lot, for $100, one lot cannot be done. Let's talk of 0.1. That is the one mini lot. Okay. So when you buy, your account has $100 and you buy a mini lot, that 100 is broken into two. A part of it, like roughly $25, it's actually like what you've used to buy. It's like moved from your equity account. It's broken into two. And it shows that is the amount held by that trade. Okay, that money is now locked and held by that trade as it continues to transact. Then the $75 is actually what we call the equity. Now that is what is actually yours as we speak now. So when that trade is operating, if it starts going into losses, your equity starts reducing. If it's going to losses, it is eating up to your equity. So if it reaches like 80% of your equity, the way the system is set, it gives you a signal. A red line will appear at the bottom there to tell you, you know what, you're getting to a red zone. You have two options. Either you add more money, it means you've committed so much of your money into this trade. So you have two options. You either add more capital or you close some of the trades which are making losses. Okay? So for FXTM, it will give you a signal when it gets to margin level of 80%. Okay? But if you don't do anything, you just let it operate once, and the trade continue going into losses. If it gets to 50%, the system will automatically close all those accounts. Okay? All this is meant to protect the broker and also protect you. Don't leave your account into negative. Okay? But again, if you've done proper risk management, you should never get into that red. Okay? If you've done proper risk management and you've already put enough measures in place for that trade to accommodate the size of your account and the kind of trade you're taking. Okay? So the margin call is when that red light appears. That signal, that is the margin call. But if you don't do anything, now the next step is margin stop out. They close all your accounts so that they ensure they are not at risk. They take away the risk from themselves. Okay? Again, you'll also see this practically when you start trading or when you start looking at our platforms. We also talk about the bulls. I'm sure you've heard a lot about the bulls. Like when you listen to business news, they talk of what happened to the bulls in the Nairobi Stock Exchange, wherever. Okay? So we also have the same language in the Forex. And in Forex, bulls are the buyers and are responsible for pushing the market up. Bulls are the buyers and they move the market up. So when there are more bulls or buyers than bears, that is the sellers, the market, just a second, my fan closed. I like to display with my phone so that I can see what you're seeing to ensure I don't leave you behind, or maybe you're in darkness and I'm already thinking we are together. But now I think you can see that screen where we have the bears. Okay, so we see when there are more bulls, all the buyers, then the bears, that is the sellers, the market moves up and it's said to be bullish. Okay, you read somewhere the dollar is bullish, it's bearish, you don't have to worry. What does all this mean? When they say it is bullish, it means there are more buyers and the market is moving up. So then we have the bears who are the sellers. When there are more sellers or the bears, they push the market down and you see the market is bearish. Some just need to understand that when you read other analysis or other analyst reports, you understand what they mean by that. Actually, you can also make a decision based on their analysis. Okay? And when you're doing your analysis, you try as much as possible to be on the side of the masses. Okay? If the buyers are the ones in charge, go with the buyers, buy. If the bears are the ones in charge, those are the sellers, sell, be with the masses. Be on the side of the masses. Swim with the sharks. Don't swim against the sharks, okay? So that's why we do analysis to see who is in control. Are they the bulls or the bears? So we move with those who are in control. That's how you are able to ensure you can make some money. But if you trade against them, they will always knock you out of the market, okay? But you'll see how we do analysis to ensure we are on the side of the bulls or the bears. When you talk of market execution price, and you say market execution means placing orders or entering trades at the bid or ask price displayed on your broker's screen. Although the price picked by system may slightly differ from what you view on the screen. Like right now, if you already downloaded your MT4 platform, when you check up there, the upper bars, you'll see somewhere written new order, okay? If you click on the new order, another screen populates, which will have the bid price and ask price, okay? Below the bid price and ask price, you will see some other two options, a buy or a sell, okay? So if right now you go to your MT4 platform, you check up there, you see somewhere written new order, click on new order, another screen populates to give you an opportunity to enter a trade. So in that screen, you'll have two prices, the bid price and the ask price. Before that, you will have another two options, a buy or a sell. So if at that moment you click on buy, it means you're buying at the market price, the current prevailing market price, okay? Now that is the market execution price. You're buying at the price already displayed on the screen. Also, if you click on the sell, it means you're selling at the current prevailing market price, okay? So that's what it means. Buying or selling at the price you can actually see at this moment. So that is one option of placing trades. Then we have another option of placing a pending order. Maybe you've done your analysis and you're like, this market, it's moving this direction, but I only want to buy or to sell when the price reaches a certain level. But I may not be here to place that order. So what I'm going to do, I'm going to set up my system such that as a pending order, when the price reaches there, it will either buy or sell, depending on your analysis, okay? So we are saying a pending order is an order that was not yet executed, thus not yet becoming a trade. It can, for example, be an order that states that you do not want to buy before the price of a financial instrument reaches a certain point. Okay? So you set up the system, and it will not be a trade until the pending order is triggered. Okay? Then we have four types of pending orders. One is called a buy stop. And you're saying a buy stop order is an order to buy a security which is entered at a price above the current offering price. How buy stop works, if I may just explain, let's say you look at the market and the price is going down. It's a bearish market. But from your analysis, you see, this market, you can see it's almost reversing. The price is almost about to turn and start coming up. And then you're saying, I'll only be sure this market has become bullish if it crosses this particular line of price. Okay? And then you say, so you set up a buy stop. I will just explain it like demonstrate with a graph. I'll demonstrate to you what all this means. So if the market has been moving down, and you can see it's almost turning, but you say, I'll only be sure this market has become bullish if it turns and crosses this particular line. So in that price is identified as the trigger for you to be sure the market is bullish. You set up an order pair. You tell the market, you go down. When you turn, when you're coming up, pick my order, fill it, and go up with me. Okay? The market is already going down, but you see from your analysis, it's likely to turn and start going up. But you're saying, I'll only be sure this market is becoming bullish if it turns up and crosses this particular line. So that particular line, now you place your order there. But the market is going up, it fills your order, and it moves up with you in profit. Then we have a sell stop. It's the opposite of a buy stop. Okay? Sorry, I hope you can hear me. I had released my mic a bit. So a sell stop is the opposite of a buy stop. Maybe the market has been moving up. Remember, we sell when it is up there, expecting it to go down. Okay? We sell when the market is up there, expecting it to go down, and we make money as it goes down. All right? Because we sell at a higher, we buy when it comes down, or we liquidate our order when it has come down for us to make profit. So if the market has been going up, and from your analysis, you say market is reaching the exhaustion point and is likely to reverse and come down. So you tell the market, I'll only be sure the bears are in charge if the price crosses this line. So you set up your sell stop order at that particular line you've already marked. Okay? So when the market goes, start coming down, it fills your sell stop order, starts coming down with you as you make your profits. Okay? Then we have a buy limit and a sell limit. A buy limit order is an order to purchase a security at or below specified price, allowing traders and investors to specify the price they are willing to pay for a security, such as stock or a currency. A buy limit, it's where you've done your analysis and you see the market it's going down. But from your analysis, it will change or it will turn direction at a certain level at the very bottom. So when the market is going down, you will set your buy limit at a point lower than the current market price. And you're saying, this price I know, once it goes down, the very bottom will be this level. So I want my order to be filled at the best price possible, at the very minimum price, okay? So that I can make the best out of the market. So you will set up your order, your buy order, below the prevailing market price. So that you are actually assuming the price will go down, pick your order, then come down with it. Okay? Then the sell limit is also the opposite of buy limit. The market is going up. Okay? And you're like, this market is about to reverse. And it's going to reverse when it reaches this particular, like the case of CAD, USD CAD. From our analysis, we say this market will reverse when it reaches 1.2005. Currently, it is at 1.2000. But I know from my analysis, once it reaches 1.2005, it's going to reverse. So you set up a sell limit so that when the market reaches there, pick your order, come down with it, you make your profit. Okay? Let me just do some analysis for you to see how that works. You can see that. So let's assume the market, this is the current market price, okay? This is the market price. You can see that, that is the market price. But the market is going down, okay? So from your analysis, the market is likely to reach here. Yeah, so you're saying, this market will come down reach there, from my analysis, the bulls will take charge and take the market up. Okay? So in such a scenario, you can set a buy limit. Okay? Buy limit, you set it here. You're telling the market, although the current price is currently at this level here, yeah, the price is here right now as we speak. But from my analysis, it will come down all the way here and start going up. So I'm telling the market, when you come down and you reach here, fill my order, which is a buy limit here, go up with me. Okay? That's how a buy limit works. But now we have the other case of buy stop. Okay? For buy stop, let's say the current market price is here. This is the market price. When you look at your chart, this is where the market is. Okay? And again, you also see the market is coming down. And from your analysis, it's like to be somewhere here. You are not very sure where. Yeah? So the market is now coming down to this level. And you're saying, once the market reaches here, I expect it to reverse. But for me to be sure this market is going up and the bulls are in control, the price has to come up until somewhere here. Okay? So at this level, I set up my buy stop. Okay? I set up my buy stop here. There's a question. I think there's something. Somebody. Sorry, I'd lost, but I'm back. Oh, sorry, Magdalene. Karibu. So we are saying, in case of a buy stop, the market currently the market is here, but from your analysis, it's going down, down, down. Okay? And you're saying, I see this market, when it reaches here, it's likely to reverse. But I'll only be sure that the bulls are in charge if the market crosses this line. Okay? This line. So I will set up a pending buy stop order here. So once the market crosses, it fills my order and goes up with me. Okay? So that is the difference between the buy stop and the buy limit. Okay? And the same case with selling. With the sell limit and a sell stop. So if the market is here, again we sell when it is very high, and we liquidate. We make money. We sell when it is up, when you expect to be coming down. So currently this is our market price here. Okay? That is our market price. And the market is going up. The bulls are in charge. Yeah? And from our analysis, we expect these bulls to just reach around here and start coming down. So we are telling the market, when you reach here, fill my sell limit. Okay? I set up a sell limit here at the very top. So when the market reaches there, I'm telling the market, when you reach here, reach here, fill my order and come down with it. That is based on my analysis. Okay? And then we have a sell stop. Sell stop, you're saying, although this market is going up, once it changes at this direction here, I'll only be sure that the bears are in charge if the market crosses this line here. Okay? So although the market is going up and is likely to turn here, I'll only be sure that the bears are in charge if it crosses this line. So at this line, I set up my sell stop. Okay? Sell stop. So I tell the market, once you turn, the bears take charge, fill my order and go down with me. Okay? So that is the difference between this buy stop, buy limit, sell stop, and a sell limit. A sell limit. Now, the main difference is that buy limit and a sell limit, they give you an opportunity to be filled at the best price possible. The best price possible. Because you're filling at the extreme price. If it is buying, you're buying at the very bottom price. If it is selling, you're selling at the very top price. So you get an opportunity to be filled at the best prices. But the risk is the market might fill you and refuse to turn. Okay? Continue going up against you, or continue going down against you. That's the only risk with the buy limit and the sell limit. But again, you also have some other risk measures we put in place to take care of that. Okay? buy stop and sell stop, they have a lesser risk. There are some conservative kind of orders because you're saying, I'll only be sure when the market has changed if it comes and fills me at this level. So they are conservative, they are not more risky, but you'll feel at a fairly not so good price. So it's like you've lost some of the profit you should have actually earned. So you get yourself based on your personality. Are you a risk taker or risk averse? Which one are you comfortable with? Okay? But again, you can always do any of the two. Both of them, they have risks. It's only that which one has a higher risk than the other. Okay? Or market execution, you decide which one are you comfortable with at the end of the day. So as you practice, you're able to know which one works well for me. As you continue practicing and learning how to place these orders. All right? Good. We move on to the next level. That is what we call long position. Okay? In Forex, when you buy a currency pair, we say you've gone long. Sorry, there's a question. Let me see. There's a question. Can you do all of them together? Yes, you can. You can do that, all of them together. You can set all those orders, and that is very much okay. Actually, the market can allow you to set up as many orders as you want. So you can always do, like if it's buying, you can set up a buy stop and a buy limit. If it is selling, you can set up a sell limit and a sell stop. Okay? So you can always do two of them. If it's buying, you do the two buy orders, buy pending orders. If it is selling, also do both of them. It is okay, you can do both of them, Marianne. Great. Okay, we proceed. So, sorry, I clicked on something. So we are talking about the long position. In Forex, when you buy, we say you've gone long. Like if you hear somebody say, I'm holding a long position in EUR USD, yeah? It means that person is holding a buy position. When we buy, we say, I'm long this position, okay? So to go long means to enter the market with a buy order. It's as simple as that. Long position means I have bought. The opposite is short position. Short position means you have sold that pair. Like if I say I'm short Euro USD, it means I have sold it, okay? Because again, we said in Forex, yes, there's some comment. I lost you. Sorry, Jackie. Hope you've not been away for long. I'm back though. Sorry, guys, but I'm recording. I hope it comes out well. Sometimes I record, and when I'm downloading it, it refuses. But I hope it comes out. I'm recording for you. We are saying in Forex, long position is to buy and short position is to sell. Because it's only in Forex you make money in both ways. By buying and by selling. So when you hear somebody say, I'm long Euro USD, it means I have bought that pair. I'm holding a long position. I'm holding a buy order for that particular pair. Short position means I've sold that pair. You know, I'm holding a short position in Euro USD. It doesn't mean like I'm in loss. Yeah, it means I've just sold it. And I could actually be at very high profit. But it means I've just sold it. It's as simple as that. Long position means I have bought it. Short position means I have sold that particular pair. Then we have stop loss. Okay. Again in Forex, when you're entering your trade, you're able, from your analysis, you decide. From my analysis, this trade, it shows the market is bullish. So I'm going to buy. But again, there is nothing guaranteed. Even the biggest of banks, they lose a lot of money. Because Forex, there is no guarantee. It's always a probability, okay? So you do your analysis and you're like, based on my analysis, there are high chances. Probability of the market going up, it's over 70%. So I am going to buy. But just in case the market moves against me, that is the amount of loss I'm willing to take. I will only take $10, not more than that. $10 of a loss. So you set up a stop loss and say, if the market moves against me, hit the stop loss and close my trade. I'm only willing to lose 5 pips or 10 pips, not more than that. And that one takes away emotions. Okay? It makes you to trade without emotions. Yeah. So it's an order placed with a broker to sell a security when it reaches a certain price. So a stop loss order is designed to limit an investor's loss on a position in a security. So a stop loss order takes the emotion out of trading decisions and can be especially handy when one is on vacation or cannot watch his or her, like you guys are working. Maybe in the morning you wake up, you get some time in your laptop, you enter a trade and you're like, I'll not have the time to watch the whole trade. You set your system. This is my stop loss. When it reaches here, goes against me, I'd only lose $10. If it goes in my favor, I just want to take a profit of this amount. So the stop loss enables you to limit your loss, and it takes away your emotions. You can imagine you've entered a trade, you've bought a particular pair, and then the price starts moving against you. There is no stop loss and continue to move against you. That's a recipe for your account to be swept and to be wiped out. Okay? So to protect, one of the priority in your trading is to protect your capital. You'd rather not trade than to enter a trade to have your account swept. So number one priority, protect your capital. So when you're trading, you must have your stop loss. You calculate how much loss am I willing to lose, and you place your stop loss based on your account size, and also based on your analysis. You don't just decide I'm only losing 10 pips or whatever. You don't just decide arbitrarily. You do your analysis and you place it at a particular position where you are so sure if the market must trigger, it means everything has actually changed. But based on my analysis, this market should not reach this particular stop loss. It should not cross this line. Okay? So because you're comfortable, you've done your analysis, you are comfortable. You've done everything right, so you let the market decide. Okay? If it goes against you, you have no emotion. You know you did it right in your analysis, and you're right for whatever the market gives you. Okay? So you don't just decide it is 10 pips. Again, we do analysis, and we'll actually discover where do you place your stop loss. How do you decide where to position your stop loss order? Okay? Then we have the trailing stop. I'll also demonstrate this on a board. Okay, Jackie, I've seen your comment. So we have the trailing stop. What happens? Once you've done your analysis and you have bought a particular currency, and then you've placed your stop loss, from your analysis, you've realized that your stop loss should be actually 10 points or 10 pips away from your entry price. Okay? If the market moves in your favor and you're already in profit, you can actually move your stop loss to above your entry price and to lock profit. Okay? There's a way you can set up. When you move the stop loss now to such a position, we change it to a trailing stop. You're actually trailing the price. Okay? You can actually set up in the system for it to trail automatically. And you're saying, I want my stop loss to be always 10 pips away from the prevailing market price. So if you have bought, let's say you bought USD CAD at 1.2 okay, then it has moved to 1.2100, okay? It means it has already moved 100 points in your favor. Then you move your stop loss. You move it from where it was to, if you want to trail at 10 pips away from the prevailing market price, you move your stop loss to 1.2080. Remember, the price has already moved from 1.2000 to 1.2100. That's where the market is right now. Okay, and you bought at 1.2000. So to lock profit, to ensure in case the market moves against me, I cannot afford to lose all this profit. And again, I don't want to close my trade. There is a possibility the bulls are going to run and run and run for a longer time. So you change your stop loss to a trailing stop. So you make it trail the price 20 points behind the current price. So every time the market moves forward, the stop loss follows it automatically. You can set this one automatically, okay? But if the market starts to move back, the trailing stop, it stops and waits for the price to come. So once it hits it, now your your trade is closed. Okay? But for it to work automatically, for it to trail by itself, the system must be on. Your computer must be on. Everything has to be online for it to trail automatically. If it goes off, it just stops where it is, at the point where the computer went off, and it will not continue to trail, but it will stop there such that if the market reverses, it will come and trigger you at that level. I want to discuss one more thing, then I illustrate to you the. Let me take you through the take profit, then I do an illustration. And a take profit order is an order used by currency traders specifying the exact rate or number of pips from the current price point where to close out their current position for a profit. Okay? So we are saying when you're entering your trade, from your analysis, you're saying if I buy the USD/CAD at 1.2000, from my analysis, it means this market will move up, it will reach to 1.2200 and it starts to reverse. Okay, so you set up your take profit order at 1.2200, and once the market hits there, it closes your trade automatically at a profit. Okay, so that is the take profit. I just want to illustrate to you those three items. That is the stop loss, trailing stop, and a take profit on a board. So let's say this is now where my entry is here. I have bought. This is the price is, the currency is USD/CAD and the price is 1.2000. Okay. Can you see my point? So now I have bought. Okay, it's a buy because the market is going up. Now, the moment I buy, I have to set up the stop loss and the take profit. Please never trade without a stop loss. If you don't want to have your account wiped out, don't trade without a stop loss. Okay? If you feel the stop loss from your analysis, if you feel you have to accommodate too many pips in a stop loss, you'd rather not take that trade. Other than just risk, say you're not comfortable with that stop loss and you just trade without it. So never trade without a stop loss. Make stop loss your friend in Forex. Okay? So let's say we bought at this level now at 1.2000. Now, from my analysis, I see the price should not come down past this level. Okay? In case it moves against me, it should not come past this level. So I will set my stop loss around here. Yeah, let's say at 1.1980. Okay, hey, that is 20 pips. That's still okay. Maybe I can take a smaller size trade. We'll see how to manage risk. Because even from your analysis, if you see your stop loss is so big, and you feel this trade is good enough, you can manage your risk by reducing the volume of your trade. Okay, so that's how we work it out. If you see this stop loss it's quite a number of pips away, but I feel this trade is so good for me to let it go, then you manage your risk by reducing the volume of your trade. If you are to enter one lot, you can enter 0.5 of a lot, that is 5 mini lots, or even a micro lot. Okay, just to ensure you participate but you don't risk so much. Okay, so from your analysis, you say if this I'm going to buy at 1.2000. Okay, but just in case this market starts to reverse and move against me, I don't expect it to go past this level. So I set up my stop loss around here at 1.1980. That means my stop loss is 20 pips away from the price at which I've purchased. Okay, and then for my analysis, I see this market might actually reach around here and turn around. Okay, so at this level, because it's a buy, the market is moving up, the bulls are in charge. At this level, I will set what we call a take profit. All these things, you just automate them so that you don't have to struggle if you don't have the time to sit at the laptop the whole day. So once is that where the take profit? Sorry, I notice sometimes my on your screen you see a lot of unnecessary lines, which actually they are not on my laptop. I don't know how some of them are just appearing. Just need to be careful when I drag my mouse, I get so. So your take profit, you see the market is likely to move up to 1.2200. Okay? Oh, sorry. Did that just happen? Did that just happen? So I've bought to 1.2000. Then so the market is moving up. It's moving up. Okay. So my stop loss is here. I set a stop loss at 1.1980. So my stop loss is for 20 pips. Okay. That's the difference between the price at which I've bought I've ended my trade at and where I placed my stop loss. And then I'm saying this market is likely to just reach here and start reversing. Okay. So and this price it's 1.2200. That means 200 of profit. Okay. So that is where I'm going to place my take profit. Okay. My TP. Okay. So that is where I put my take profit. So if the market moves up, my entry I entered, it moves up to here and it hits my take profit, the trade is automatically closed at a profit of 200 pips.It once the market reaches somewhere here, okay, at around 1.2100, okay, just ignore some of those diagonal lines. I don't know how they're appearing. On my screen they're not appearing, but I know on your screen they can appear. So once the price reaches this level at 1.2100, I can now move my stop loss from here to this level. Okay, and now it becomes a trailing stop. I'm now trailing the market. It changes to a trailing, and then you lock your profit. Okay, and then you can just set automatically to trail the market at around 20 pips. It's just a demonstration that we'll actually do it now practically when you go to the platform. But that's how the take profit, the stop loss, and all that, how they work. But if you have any question, please ask. So with the moment you enter your trade, you have to determine where am I going to place my stop loss, where am I going to position my take profit. Okay, there are traders who can comfortably trade without a stop loss, but those are traders with huge amounts of money where their accounts can go into negative, even to $100,000, because they know at some point the market will change. Okay, but your account and mine cannot accommodate $100,000 of a loss. So we must have a stop loss. Okay, but there are traders who comfortably trade without a stop loss and they are making money. But as you start, make use of a stop loss. Yeah, when now you are confident in what you're doing and you can take that kind of a risk, but not a risk I would advise anyone to take, to trade without a stop loss. So we'll do analysis later to see where do you position your stop loss based on your analysis. Okay. So we go to dovish. This term dovish and the hawkish, they go together. Yeah. And the dovish tone from central bankers indicates that they are considering loosening monetary policy due to the economy growing under potential, a sign that interest rates will be cut or more quantitative easing. That sounds complicated to you. Let me simplify it. What happens when the economy of a country is doing so well? Chances are the inflation will go up. So for the central banks, which are the ones who are the custodians of the monetary policies, how they do to tame the inflation, they increase or they raise the interest rates. I'm sure I think the CBK, if I'm not wrong, every month or quarterly or something, they release that CBR rate or the CBK rate. I'm sure you guys, you follow that. So because they have to sit and analyze, how is the economy doing? Do we need more money in the market, or do we need to mop the money from the market? And they do that using the monetary policy, okay? This quantitative easing is where they make use of the treasury bills, the bonds. So they look at what kind of, which asset are we going to use to achieve our objective. Is it increasing interest rates? Is it making our T-bills favorable or our T-bonds favorable? So those are the assets or the items they use to control, or rather to control the amount of money in circulation. So when the economy is doing so well, and the investors, let's talk about the United States. The economy is doing so well, the inflation is going up, then there are people who do analysis, and they do a survey, and they predict the next meeting by the Federal Reserve Bank of United States, the Central Bank of US, when they meet next, they are going to raise the interest rates, okay? So if that is the expectation, then the dollar is going to increase in value, because investors always want to buy the currency with a higher interest rate, because that's how they earn. Of course, for us, that is not actually what we are looking at, but we ride with them. We have to move with these big guys, okay? So when they expect the interest rates to rise, then that currency will attract more investors, so the demand will be high and the value will go up. So when the opposite it happens, maybe the economy is not doing so well, they want to pump more money in the market. They will lower the interest rates. They will make the currency less favorable, and it goes down. Okay? So about the dovish tone, many times I told you to download the factory forex calendar. It always has schedules of what is expected for each. It's always good to have a glance at it. What are we expecting today? Which news are likely to affect the market? So at times we find there are speeches by the governors of those central banks who are scheduled to give a speech. So if the governor will speak in a way to suggest that they are likely to lower the interest rates, we call it a dovish tone. If the talk is in such a way that they are likely to lower the interest rates by the central bank, that's a dovish tone. And that one is likely to cause that currency to lose value, because it will not attract investors. They run away from it, then it gets devalued because there is no demand for it. They'll actually sell it off, okay? So the value goes down. But if the way the central bank governors are talking, there's a possibility, the tone, it tries to tell us that they are likely to raise interest rates. That's a hawkish tone, okay? Which will attract more investors and cause the value of the currency to go up. Again, you don't even have to listen to them. These terms are to help us. Once in a while, you read other people's analysis, and you hear the tone was hawkish, dovish. It gives you an indication what is likely to happen in that currency pair. It's just good to understand some of these terms used by other analysts for you to be able to flow with whatever is available to you. You are not just wondering what is all this dovish and hawkish tone. Yeah, because every month you'll always find these guys scheduled to talk. Okay? So when they speak, now it affects. Their speech always affects the movement of some of these currencies. Okay? Then you go to volatility. And you're saying volatility in forex trading, it refers to the amount of uncertainty or risk involved with the size of changes in a currency exchange rate. A higher volatility means that an exchange rate can potentially be spread out over a larger range of values. Actually, volatility is what makes the forex. Because if there is no that volatility and high movement, it means the currency may not move for so many pips in a day. But the more volatile the currency is, or the pair is, the high chances it will move by many pips, okay? So it actually now gives us an opportunity to enter a trade, hold for a lost period of time and take our profits, or at least we get an opportunity to lock our profit and let it run. Okay, when already we know we've secured our trade there. Also, volatility tends to increase with the release of news. There are some news which cause higher volatility than others. Like when you look at that calendar, the Forex factory calendar, when you look at the schedule, some are marked red. Red means they are very important news. They are likely to cause a lot of volatility in the market. If they are orange, it means it's medium volatility. If they are yellow, it means they may not really cause any change in the market. So during news release, if there is high volatility, there are some news you just decide I'm not going to trade, because some news also cause the spread to increase. Some news can actually cause the spread, that is the difference between the ask price and the bid price, to differ by almost 10 to 15 pips. Okay, so there are some news you just say this one I'm not going to trade. Okay, but later I'll take you through all the news reports released by the certain central banks and what they mean. And when you're expecting those reports this month or this week, what do you expect? And what are you supposed to do to either take advantage of it or to be away from having your account lose so much? We'll go through all those reports at a later date. I think I put it's under fundamental analysis that we'll look at it. I will take you through that. Then we have the term liquidity. And I think I mentioned to you what liquidity is all about. Hope you can hear me. Here at our place it's really raining and there's a lot of thunder. But if you can hear me, that is very good. So we talk about liquidity, and we say it's the degree of an asset's ability to be converted to cash. This I don't have to really dwell on it so much, but you're saying Forex market is the most liquid market in the world. Okay, let me see. You can hear me. Thank you. Thank you, Maggie. When it comes to liquidity, the Forex market is the most liquid market. What it means, there is always available buyer, available seller. You can enter your trade right now. In 2 minutes, you liquidate it. You don't have to wait for someone to come from wherever to come and buy your goods. Yeah, like when you open a store at Moy Avenue. You only depend on a buyer coming from wherever to come and buy your dresses. Okay? But Forex market, there is always, every second, every minute, there is available buyer, available seller. You only need to click a button, you liquidate your trade. Click a button, you buy. Click a button, you sell. It's the most liquid. You can convert it to cash within a second, within a minute. That's what it means to be the most, because again, it has so many investors. It has many participants, okay? And in a day, more than $5.5 trillion is actually traded in the Forex market. It's bigger than the New York Stock Exchange. So it's a market you should be comfortable to participate and get something out of it. Then we talk about the technical analysis. And we say technical analysis is a trading tool employed to evaluate securities and attempt to forecast their future movement by analyzing statistics gathered from trading activity, such as price movement and volume. So in our case, we'll actually dwell so much on technical analysis, but looking at the price movement. You look at the price movement just prior to the current price, you do your analysis, and you're able to predict or form an expectation. Now, I expect the market to move in this direction, either in a bullish direction or in a bearish direction. Then you enter your trade based on what the price chart is telling you. Again, you're going to look at all this, do analysis, and then make decisions based on our analysis. So in technical analysis, you basically use the chart, the price chart. What is it telling you? The previous market movement, come to the current, then you predict. So where is it moving next? Then from there, you're able to make a decision. Then we have fundamental analysis. Well, so if you think it's difficult to value one company, try valuing a whole country. That's just but a saying, don't scare you. Okay? So fundamental analysis is in the Forex market, it's often very complex and it's usually used only to predict long-term trends. However, some traders do some short-term strictly on news release. There are some traders, okay, fundamental analysis is where you actually now depend on the reports you are talking about. You look at what reports are being released from the US this week, because every week we have reports. What matters most is, are those reports key? Are they likely to trigger the dollar to move so much? So every week you can be assured there will be report from the dollar, report from the GBP, and reports from the euro, the 8 major currencies, okay? So you look at, you just count through and you're like, are they likely to cause the market to move? So that will help you either to stay away from the market or to make informed decision. But what I can tell you is that these two go hand in hand. Technical analysis and the fundamental analysis. Even those guys who strictly depend on the news release, okay? They also look at the technical analysis, okay? Also, because of what we call the market sentiments, okay? Let's look at the fundamental analysts. And now from the reports, let's say they are expecting the interest rates to increase. They will start behaving in a way to cause the market to move up. And because of that, the price chart will start displaying some kind of, some behaving in a way to complement what the fundamental analysts are thinking about. Because remember, this market is not just a robotic market. It is made of human beings all think alike. Yeah, all think alike. So that forms what we call the market sentiment. And then it comes into play also in the technical part of the chart. So you can never cut this one. This is fundamental analysis, the technical. They actually move hand in hand. And many times they complement each other. More often than not, when you do your technical analysis and it tells you to buy before the fundamental reports are released, you come to realize even the reports, they actually also signify you need to buy. I've tried that. It's not always, but the most chances are because the market sentiment, they always speak the same language. So you don't have to be here, you're in technical, tomorrow in fundamental. Just try to adopt one and run with it. But you can never work with technical analysis and you ignore the reports from those countries, okay? Like right now, I cannot just look at the chart and I ignore what is happening in Britain with the Brexit, okay? Because those news, every day we have unscheduled news, yeah? Theresa May coughs, the dollar jumps, yeah? The guy in the Europe, Tusk, he coughs, GBP again jumps, okay? So I cannot just assume that whatever is happening in Brexit does not affect the technical analysis. So you have to try to balance the two. Just have something in the back of the mind. This happened in the US, the election in the US, so we expect some things to move. So you're able to follow those news. Again, you don't have to just sit in a screen the whole day, watch CNN to know all this. Sometimes you just subscribe. Even that Forex Factory, they always release, there's a portion for news release. You can always glance once in a while and see what are the news there. What are they saying? Even when May coughs, they put the cough there, okay? The cough, of course, will mean, I just say when he speaks something about the Brexit, okay? So these news are all over. You don't have to struggle. Like as we speak already, I've received already 2 alerts from there, what's called the Bloomberg, okay? So you subscribe, they keep on sending you some reports here and there, but again, it should not worry you. You don't have to ask, when am I going to work? No, don't worry. Do your analysis, the rest will just fall in place. You don't have to worry about what is coming at what time. Yeah, only once in a while. Like I remember that sometime in 2017, it was in April. I entered this particular trade, and by then I was not using stop loss, because my trainer at that time told me not to use stop loss. And I was in good profit. I was excited. I was very happy. I didn't even know how to log profits. I just let it run. My analysis were right. And then I remember I had actually bought Euro GBP. Then from nowhere, yeah, Angela Merkel, the chancellor for Germany, she just speaks to the president. She says, oh, Euro is too strong. And I'm telling you, N words coming from Angela Merkel, Trump, which mentions the currency. It will just make the market think, I don't know, like just change direction, you know. And then you see, for me, it will take a while for me to know this lady has spoken something like that. Before you know it, the market has changed. It's running against, and you're like, what is it running away from? You know, I was not in profit. What is happening? And before I knew it, in less than 5 minutes, I had lost $1,000, you know. And those are some of the reasons why you must use a stop loss. When you move into profit, lock your profits, so that in case it moves against you, at least you not come out negative or you lose everything you had earned. You're able to come out with something, okay? Because some of these news are never scheduled. You look at the Forex Factory, you see all the news, but once in a while, Trump will shout something or tweet something, is always tweeting, or Theresa May shout something and just it causes the market to move. But as long as you've done your analysis, you don't have to be scared what they're going to say. It doesn't matter. Sometimes even before they speak, some of the guys are already aware these guys are going to speak, and they're likely to talk in this kind of direction. So the market sentiment is already causing the technical analysis to fall in place as per your analysis. So you don't have to worry, must I actually followed Trump on Twitter when he was tweeting, but I realized it doesn't help. It doesn't help. I can't tell the last time I even looked at his tweets, because he tweets like almost 20 times in a day. Do I have time to follow that? No, it's not possible. So it should not bother you who is tweeting, who is writing what. Eish. Sorry, can you still hear me? That thunder has frozen everything. Yeah, we are back. We are good again. Sorry, here the thunders are louder than anything else. They really scare me. You can hear me, yeah? Thank you. Thank you. So now, I'll say you don't have to bother so much. What is Trump going to say? What is the Theresa May going to say? Just do what you feel you're comfortable with doing. Do your analysis, set up your trades, and go on with life. Work as though there is nothing running behind your back. If you go to your office, you set up your trade, don't bother. You can always peep from your phone. That's why we say we download the FXTM app. The prices are real time on your phone. You just peep. Hey, it's already my profit. You can actually maybe pull your laptop, move your stop loss to lock your profit, and continue the business serving your customers as though nothing is happening. It's very possible. There's an online chat we do with so many guys all over the world, and a good percentage of guys are actually working. Yeah, they are working, and they're able to just, sometimes they actually share how they control their transaction even as they do their work. You can actually do it without any stress. As long as you get to know how to do your analysis, place your trades properly, and you trail them. Then you don't have to be worried. What's going to happen? I'm in the office. Okay? You don't have to worry about that. You can comfortably do that as you do your office work. Okay? Then we go to support and resistance. Okay? And you see, support and resistance is a common jargon for areas on the chart where price has a difficult time breaking through. Support levels tend to stop price from falling below a specific point, and resistance levels act like a price ceiling that price cannot break above. What happens then? Again, because we said guys in the market, they behave the same. And an area which was support 10 years ago is like to play as support today. An area which was support last week, it's likely to play support today. An area which was support last week, even on Friday, it will play support today. Because everybody has that thinking. You know, we are all human beings, we think alike, and we know when the price reaches this level, it tends to stop. Okay? And that is where decisions are made, whether to buy or to sell or to close your trade at a profit or at whichever direction you're at. So what happens? It's a situation where, let's say currently we are all seated on second floor. Okay? If you're on second floor, that floor is our support. We are standing on second floor. So the floor of second floor is our support. It's supporting us, we cannot fall through. But just in case we have so much weight, or we jump and hit it with so much strength, and we push through the floor, we'll go and land on the first floor. Okay? Remember, we were standing on second floor. We pushed through the floor. We've gone through. Now we are standing on first floor. So now the ground floor, it becomes our ceiling. Now the floor on the first floor becomes our support, and the ceiling, which was initially the floor for the second floor, becomes our ceiling. That's how it works. When the market reached an area of support, and you'll actually see how do we identify support, how do we identify resistance. It's very easy. You don't have to worry how you go about it. It just comes automatically when you learn how to draw the lines or the zones, the support zones and the resistance zones. When the market reaches a support zone, everybody, and also when you use what we call the Fibonacci retracement, I'll show you how to draw all that. Do not worry about all those big terms. So when the market reaches there, everybody is watching. If it's a support, the price has been coming down, it reaches there, it starts struggling to go through. Now that there is a fight between the bulls and the bears, okay? So whoever takes the day, if the bears win, they penetrate through the support, they go down, and now that support line becomes the resistance, okay? Anytime they break one, if they break support, that support becomes a new resistance. If they break resistance going up, like breaking through the ceiling, if they break up, that resistance becomes the new support. And that is always automatically, because that's how everybody in the market, even the big bugs, everybody has to respect a support zone. Unless there is something triggering the market to move at such a high speed, it can just go through the support or the resistance without any resistance or without any support. Okay? So we'll see how all these changes, how support change to resistance level, and how we take advantage of the support and resistance levels, either to end our trades or which decision you can actually make when the price reaches such kind of levels. Okay? Then we go to another level called gap. And you see gaps are areas on a chart where the price of a stock or another financial instrument moves sharply up or down with little or no trading in between. Just to explain with simple words, what happens? Like today, as we speak right now, okay, the market has 3 sessions. We have the Asian session, is the first one in the day. Then we have the London session and the New York session. Of course, in between the areas, they overlap. Okay? So, right now we have the New York in session. London has just closed. Yeah, London closed at around Hello, can you hear me now? It should be fine now. I should be back on air. Can you hear me now? Great, thank you so much. Jackie, I'm sure you can also hear me. So we're actually winding up. Eh? So our last bit was just the gapping, which I've explained. Yeah. And I think I explained when I was off air. I just go through it briefly. And we said the gapping happens if the market opens at a different price than the previous day's closing price. Okay. And if the gap is not closed during the Asian session, when the gap actually started, then that gap is likely not to be closed. The market is likely to move in the direction of the gap for a long period of time. Okay. So I think you can at your time just read the types of the gapping. They are not so necessary, just for your own information, but they really don't mean so much. The main thing just to know generally what a gap means and how you trade a gap. So we'll see how do we take advantage of a gap. Then the last page about the major currency. I'm sure you can see that screen, the major currency nicknames. Also, these nicknames are just to help you. In case you come across some analysis, how do you interpret them? Okay? Because some analysts, in the analysis, they just quote the currencies by their nicknames. You'll hear them say the greenback or the back now it is bullish. You don't wonder now which currency is called the back. Okay? So the essence of us, or the importance of us knowing the nicknames, just for us to understand some of the analysis as it is shared by other analysts and as you come across other reports. Okay, so the dollar, they call it, the nickname is the greenback or the back, GBP the cable, euro the fiber, CAD the loonie, CAD is the Canadian dollar. Okay, the New Zealand dollar or the NZD is the kiwi, CHF or the Swiss franc is the Swissy, Australian dollar or the AUD is Aussie, then the Japanese yen, the yen. So those are just the nicknames which once in a while the analysts will use that. So you just need to be on the same page with them to know which currency, when they say the kiwi is behaving like this, which currency is that. So these are the 8 major currencies which you're going to focus on more. And again, we focus on them because they are highly traded, so they move more in a day. You don't want to buy a pair which will take 3 days to give you $10. Okay? Talk of the Mexican peso, the Turkey what, they are guys who are experts in those currencies, those who are doing it as their large time business because they know when to time how they move. But for us, the best for you to do is to focus on the 8 major currencies and the pairs, okay, how to pair them. So we go into details in this with time, then we study. So from tomorrow now, we go the real Forex discussion. We do the introduction to Forex and start getting deeper and deeper. Great. Do you have any question before we close for the day? Any question? Any question or clarification? I think you also know for now. Okay. Have a nice evening. We'll see you tomorrow. And other questions come, please ask them anytime. Have a good night. I'm going to end the session.